Reuters, the U.S. House of Representatives gave final approval on Wednesday to a sweeping, debt-financed tax bill in a midday vote. It now will go to President Donald Trump to sign into law, although the timing of that was unclear. The Senate approved the bill early on Wednesday. Here are the key parts of the bill, representing the biggest overhaul of the U.S. tax code in more than 30 years. Business corporate tax rate cuts corporate income tax rate permanently to 21% from 35%, as of January 1, 2018. Pass-throughs creates a 20% deduction for the first $315,000 of qualified business income for joint filers of pass-through businesses such as partnerships and sole proprietorships. For income above that threshold, the legislation phases in limits, producing an effective marginal tax rate of no more than 29.6%. Corporate Alternative Minimum Tax repeals the 20% corporate alternative minimum tax, set up to ensure profitable corporations pay at least some tax. Territorial System exempts U.S. corporations from U.S. taxes on most future foreign profits, ending the present worldwide system of taxing profits of all U.S.-based corporations, no matter where they are earned. This would align the U.S. tax code with most other industrialized nations, undercut many offshore tax dodging strategies, and deliver to multinationals a goal they have pursued for years. Repatriation sets a one-time mandatory tax of 8% on illiquid assets and 15.5% on cash and cash equivalents for about $2.6 trillion in U.S. business profits now held overseas. This foreign cash pile was created by a rule making foreign profits tax deferred if they are not brought into the United States, or repatriated. That rule would be rendered obsolete by the territorial system. Anti-base erosion measures prevents companies from shifting profits out of the United States to lower tax jurisdictions abroad. Sets an alternative minimum tax on payments between U.S. corporations and foreign affiliates, and limits on shifting corporate income through transfers of intangible property, including patents. In combination, these measures with the repatriation and territorial system provisions represent a dramatic overhaul of the U.S. tax system for multinationals. Capital expensing allows businesses to immediately write off, or expense, the full value of investments in new plant and equipment for 5 years, then gradually eliminates this 100% expensing over 5 years beginning in year 6. Also makes changes to permit for more expensing by small businesses. Interest deduction limit caps business deductions for debt interest payments at 30% of taxable income, regardless of deductions for depreciation, amortization, or depletion. Clean energy preserves tax credits for producing electricity from wind, biomass, geothermal, solar, municipal waste and hydropower. Carried interest leaves in place carried interest loophole for private equity fund managers and some hedge fund managers, despite pledges by Republicans including President Donald Trump to close it. These financiers can now claim a lower capital gains tax rate on much of their income from investments held more than a year.